Bull Bear Buzz Podcast for decoding markets, fueling minds.
Okay, so you've joined us today because, well, you want to get a real handle on what's going on with HDFC Life. We're diving deep into their performance. You sent over quite a bit of material, the FY25 results, analyst call recording, investor presentation, the press release. Our job here is basically to sift through all that and pull out the really important stuff, give you a clear picture of how they did and, where they might be going. We'll hit the key things: financial growth, market position, product mix, future plans, all those crucial numbers.
Exactly. And it's a really rich set of data you provided. It lets us build a pretty comprehensive picture of their last year. We'll focus on the highlights, the things that really tell the story of their achievements and their strategic direction without getting totally bogged down in every single detail.
Right. Let's unpack this then. Starting with their overall performance in FY25 looks pretty robust, doesn't it? They flagged an 18% jump in individual APE. What was really driving that?
Yeah, that 18%. What's interesting is how balanced it was. It wasn't just one thing. It came from a 9% increase in the actual number of policies they wrote, and also a 9% increase in the average size, the average premium of those policies.
Okay, so growth on both fronts. That sounds sustainable.
It does suggest that, yeah.
Sure.
Rather than just, say, pushing bigger tickets, which can sometimes be a bit more volatile,
And it seems they're gaining ground in market share, too. The press release mentioned, a 70 basis point increase overall, bringing them to 11.1% for the 11 months ending March 25?
That's right. And specifically in the private sector, where they seem quite focused, they saw a 30 basis point increase. That took them to 15.7% share there.
30 basis points, okay.
And importantly, something highlighted on the analyst call was that their policy count actually grew faster than both the overall market and the private sector average.
So they're really reaching more people, not just collecting more premium per person necessarily.
Precisely. It suggests they're expanding their customer base effectively.
Which ties into this other point, almost 3/4. Nearly 75% of their new customers in FY25 were buying from HDFC Life for the very first time. That really stood out to me.
It's a striking number, isn't it?
It really is. Does that signal they're successfully breaking into new groups, maybe younger people or those who haven't had insurance before? What are the long-term benefits there?
That's exactly the right way to think about it. A high number of first-time buyers strongly suggests they are acquiring new customers successfully. And they did point out that Tier 2 and Tier 3 markets were big contributors here, especially looking at the number of policies sold.
Right, smaller cities and towns.
Yeah, and getting customers early in their financial journey, well, that can build long-term loyalty. You potentially get more business from them as their needs change over time. And we shouldn't forget the scale here either. They mentioned covering roughly 50 million lives in FY25. It's a huge number.
50 million. Wow. Okay, let's shift gears a bit. What about profitability? How did they fare in terms of creating value, the bottom line?
Well, the value of new business VNB that saw pretty healthy growth, up 13% to 3,962 crore. VNB is basically, a measure of how profitable the new policies sold during the year are expected to be.
Got it. Profit on the new stuff.
Exactly. And then their actual profit after tax, the PPT, that also grew solidly, up 15% year on year to 1,802 crore. A big driver behind that PEAT growth, interestingly, was an 18% increase in profit emerging from their existing policies, what they call the back book.
The back book. So profits from policies sold in previous years starting to come through.
That's right. As those policies mature, initial costs drop off, and the profit gets recognized over time. It provides a stable base.
That sounds like a really important foundation. And for shareholders, I think there was news on a dividend?
Yes, the board recommended a final dividend, 2.1 per share. And looking longer term, their embedded value, or EV, which is sort of the total value of the company based on existing business profits plus net worth, that grew a substantial 17% to 55,423 crore.
17% growth in EV. Okay.
And they also reported a 16.7% operating return on that EV, which basically indicates they're generating value pretty effectively from the overall business.
So it's not just growth for growth's sake. They seem to be growing profitably and building that long-term value. What about their overall financial footing? Stability.
Looks quite strong. Their assets under management, AUM, basically all the money they manage, grew 15% year on year, reached a pretty hefty €3,036,282 lakh crore by March end.
That's a huge number.
It is. And crucially, their solvency ratio stood at 194%.
194%, and the requirement is 150%, right?
Correct. So they're well above the regulatory minimum. Think of it like a safety cushion, how well they can meet long-term promises. A higher ratio means more cushion.
Makes sense. Okay, let's dig into the products then. What kind of insurance is driving this? What's the mix look like?
Sure. If you break down their individual APE, unit-linked plans, ULPs, the investment-linked ones made up 39%. Then you have non-participating savings products, the ones with guaranteed returns, at 32%. Participating products, where you might get a share of profits, were 19%. And term annuities, for retirement income, about 5%.
Okay, quite a mix. Any particular areas showing strong growth?
Definitely. Non-par savings were quite robust, up 25%. And retail protection also showed good momentum, also up 25% in APE terms.
Interesting. Now, the analyst call did mention one area that was a bit slower, didn't it? Credit Protect.
Yes, exactly. Growth in Credit Protect that's insurance tied to loans was more muted. They linked it mainly to trends happening in the microfinance, the MFI space. But it's worth noting, even with slower growth, they said they maintained their market leadership position there.
Okay, so holding steady despite headwinds.
Right. And on the flip side, they highlighted better attachment rates for riders, those optional extras people add to policies. And their annuity business grew faster than the industry average.
Gotcha. So looking ahead now, what's the game plan for this current year, FY26 and beyond? Did the call or presentation give much away on strategy?
They did. They expect certain products might do particularly well in FY26, maybe helped by potentially lower interest rates eventually, and perhaps ongoing jitters in the equity markets, making savings products look attractive.
Makes sense.
And they introduced something called Project Inspire. Sounds like a big, long-term thing.
Project Inspire, what's the goal there?
It's focused on creating sort of strategic advantages, moats they call them, improving the customer experience, and potentially getting cost savings through more automation and using data better.
Okay. Did they put any numbers on that, like impact on margins?
Not specific margin percentages in the short term. They framed it more as a 3 to 5 year play. The benefits are expected in things like keeping partners happy, growing the top line, and just being more efficient overall. They mentioned a positive cost benefit across, I think, 9 different streams within the project.
Yeah. Right, so a long-term investment. Speaking of investments, they also talked a lot about tech, didn't they?
Absolutely. Big investments going into technology and digital capabilities. Sometimes they called it tech transformation. Other times, Project Aspire. Seems it might be the internal name.
Okay, Project Aspire for tech. And how does that impact things now? Does it drag on margins?
They were upfront about that. They said margins are likely to be kind of range-bound in the near term because they're making these significant investments. But the idea is these investments are crucial for the long haul. Again, think 3 to 5 years for the full benefits, better productivity, better experiences to really show up. Their analysis apparently shows it'll pay off.
Right. Investing now for future gains. And it seems expanding their reach, especially outside the big cities, is still core to the plan.
Very much so. That focus on Tier 2 and 3 markets is clear. Like we said, those areas drove about 75% of new business last year, just based on the number of policies.
75% by policy count. That's significant penetration.
It really shows it's working. And their overall strategy is kind of multi-pronged. Profitable growth, yes, but also diverse distribution, using agents, banks, direct channels, brokers, plus a big focus on the customer, managing risk well, and of course, leveraging all this tech investment.
Let's quickly revisit some key metrics. Persistency rates, how long customers stick around, always important for insurers. How are those looking?
Pretty consistent, actually. They reported 87% for 13th month persistency.
Yeah.
So people keeping policies for at least the first year. And 63% for the 61st month, which is the 5-year mark.
63% at 5 years. How does that compare?
What's encouraging there is they noted a significant improvement in that 61st month rate. So they seem to be getting better at retaining customers over the longer term, which is obviously good for profitability.
Definitely.
The analyst call also threw in a comment about the life insurance sector, generally showing resilience within the Nifty 50 index, seen as relatively stable.
Okay. And the broader industry trend, private players versus LIC.
That continues. The trend of private insurers, HDFC Life included, gaining market share relative to LIC is still very much in play.
Yeah.
It reflects that ongoing competition.
Right. And the overall economy.
Well, the general backdrop they mentioned is India's economic resilience, despite global ups and downs, strong domestic demand, services sector doing well. That generally helps the insurance sector, though they're always mindful of potential short-term bumps.
Makes sense. Okay, nearly there. Let's quickly touch on shareholder value and the customer experience side.
Sure. On shareholder value, they consistently talk about their focus on growing that VNB we discussed and compounding the embedded value over time. It's about balancing profitability with central risk management.
And for the customers themselves.
Big push on digital. They mentioned over 90% of service requests are now handled through self-service channels. That points to their digital platforms really working for people.
90% self-service, that's high.
It is. And they highlighted specific things like zero-touch processing for some transactions, getting policies issued instantly, and even same-day claim processing for eligible claims, all aimed at making things smoother and faster for the customer. Oh, and they briefly touched on ESG too. Ethical conduct, responsible investing, diversity, employee engagement, sustainability, the usual pillars.
Right, covering all bases. Okay, so to wrap this up for you, our listener, HDFC Life showed, well, pretty strong momentum in FY25, good growth in APE and VNB. They're definitely increasing their market footprint, seem focused on long-term value through these big investments in tech and customer initiatives via Project Inspire and Aspire. And they've got this kind of rounded strategy for future growth expanding reach, especially in smaller towns, and really leaning into digital.
Yeah, which leads to maybe a final thought for you to mull over. HDFC Life is clearly trying to balance this strong top-line growth with making these significant long-term investments. How do you think that positions them in India's insurance market as it keeps evolving? And maybe what specific things, metrics, developments will you be watching in the next few quarters to see how they're tracking against these plans and if these big strategic bets are starting to pay off?